And now it's time we move forward to the next panel discussion. It's time the stage is all set for a panel up there that will focus on collaborate and grow scaling, co-lending and securitization with compliance at the core. Well, as we all know that co-lending and securitization are reshaping financial access, enabling better credit distribution while maintaining compliance. And this particular segment, this panel discussion will explore how financial institutions can really scale co-lending models while ensuring regulatory adherence. And we have some prolific speakers who would be joining us on stage to navigate on this topic. First up, may I please invite Mr. Ramaswamy Subramaniam, Chief Product Officer, Karnataka Bank. Let's put our hands together. Warm welcome to you. Next up, I'd like to extend a very warm welcome to Pulak Jain, Co-founder and Chief Business Officer, Transbank. Well, it's time we bring all that energy in. Let's invite all our speakers by putting our hands together. Everyone. Warm welcome to you, sir. May I also please invite Mr. Amit Mandanya, EVP, Partnership-Based Lending, Northern Arc. Warm welcome to you, sir. And to lead this conversation, may I please invite, we have with us Mr. Shashank Shekhar, Co-founder and Head of Consulting, The Digital Fifth. Well, over to you, Mr. Shashank, to take this forward.
Yeah, good afternoon, everyone. I think after lunch, the energy still looks low, but hopefully we catch up on some energy. Because there's an interesting session coming up. I think before the session itself, throughout the day, since we are running and lending in this track, co-lending has always been one of the questions coming up, Rama. So we will try to have more questions from the audience this time. So I think co-lending has taken a good inroads in the country, especially in the lending space, and NBFCs and fintechs and the banks has lapped it, but I think it has a long way to go because some of the questions were there. So we'll just straight go to the topic. Ramas, if you can just give the audience some insights into how the growth story of co-lending so far in the country.
Thank you, Shashank. Firstly, very happy to be here. Thank you all. And welcome to my fellow panelists also. So co-lending is, started off in 2018, as many of you would know. It's a 6-year-old business today. So from that perspective, as Shashank said, pretty long way to go. I read somewhere that it's reached around 1 trillion rupees in terms of AUM, which is around 1 lakh crores. In isolation, a big number, obviously. But in context, if you see from an overall lending perspective, it's still pretty much a scratch on the surface. So yes, it has grown well. There have been regulations which have come in 2018 and then 20, which kind of given more clarity to how the co-lending model should evolve. Many of you would know there are two models. There is a CLM1 and CLM2. A lot of the action is happening actually more in the CLM2 space, and reasons for that is very clear. It also to do with the kind of technology and other things which need to kind of come into play for co-lending, because there is a bit of a deep integration which needs to happen between the NBFC partner and the bank partner in this case. And because of that, the CLM2 space, which is where the NBFC first originates the case and then passes it on to the bank for their share of 80%, right, is the model which is kind of gained more prominence, and that's where most of the players are today playing. Overall, if you see out of the 1 lakh crores, roughly around, at least in the past, the trend has been that there's been more of business towards the personal loan side. Almost 1/3 of the book is personal loans. Home loans constitutes around 20%. And then there is MSME, unsecured, which is 13%, and then the rest. There is LAP and vehicle loans, gold loans, all of that constitute the rest. So that has been the trend till date. Lately, we are seeing a lot of changes happening. We are seeing a lot of thrust and movement towards secured form of lending, even in the co-lending space, because that is where I think even banks are a lot more comfortable. Not to say that unsecured is not happening, but yeah, there is definitely a movement towards more of the secured lending. Overall, there are quite a few challenges, and I'm sure we'll be speaking about them as we go forward, whether it is technology, whether it is risk, customer ownership. All of those areas are still kind of evolving. Overall, I think co-lending is obviously here to stay. I think it's a great way for both banks and NBFCs to collaborate and do much better for their own reasons. Both have the benefits of co-lending, obviously one from a perspective of getting capital, which is the NBFC, access to funds, and of course the banks, ability to, one, of course, meet their PSL requirements, which is one big driver for the PSU banks and for other banks. And of course, in terms of being able to reach new geographies, being able to reach new markets, new customers, and so on. Thank you.
Yeah, thanks, Ramos. I think it's a good take to start that wonderful discussion. I think, Pulak, so you are due as tech enabler, and I'll come to you. So maybe you can share your initial thought that how the technology is shaping up this whole co-lending. Because Ramos also spoke about the technology play a larger role. So maybe your initial thought on technology.
So per se to say around 1 lakh crore, I will put it then into the context. Say digital lending has 30 lakh crore. Say 1 lakh crore is somewhere around 2.5, quarter to 3%. 6 years of span. I think we are still not there where we want to be. It's an awesome product. It's a wonderful product. And when we say co-lending, it's kind of a model only. Lending is the underlying, objective of this. Everyone wants to lend. Why they are not able to do so? So I personally feel to take it off to the next level, I think tech is the key, which is still not there. And for that, I think right now we are at a stage where it is actually going to take off. We are looking at, as Ramesh also suggested, deep integrations are required for such kind of arrangements. Now for that, it takes time. And that actually is kind of a revenue loss which is there for this. So I think tech is going to play a very important role. And as ourselves also working on this, open finance infrastructure will be something which will be used for co-lending primarily, which will take it from here to almost like 10x in a shorter span rather than 6 years. That's what my take on this.
Thank you, Pulak. So now come to Amit. I think Northern Arc, known as one of the leading NBFCs, which has adopted co-lending at a great extent, like your good number of business comes through the co-lending. So maybe you can just share your initial thought that what are the critical factors that one need to consider to build that partnership-based co-lending business?
Sure. So see, at the core of it, as we understand, this is two lenders coming together. Specifically in this case, we're talking about banks and NBFCs. NBFCs have built their own niche, segments, and they cater to a segment which banks are not able to. Banks have their standard processes, but when the two of them come together, they need to operate in a synergy which allows them to build the portfolio in a scalable manner. So I guess, there are challenges which the banks need to sort of take care of here. We're talking about banks being able to strike a balance between maintaining a portfolio which is sustainable, at the same time giving the customer and the NBFC partner or the fintech partner the experience that they need. This interaction is where I guess a lot of challenges are there. Selection of partner is one where they need to definitely select a partner based on their sort of credit requirements. But the day-to-day interaction is where the challenges are key, which is where designing the program in a manner where banks are able to strike that balance is important. I think from a regulatory perspective also, banks are required to treat this portfolio as a co-lending portfolio, wherein today the the regulator and the bank's expectation also is that they have enough control on the customer selection, on underwriting, on funds flow, and the life cycle management of the portfolio. Specifically, when you come to CLM1, the risks are much higher because the customer also gets involved into the whole interaction. So I guess banks need to be more agile. They need to invest in systems which are able to take care of their needs, are able to build sort of this portfolio in a sustainable manner, wherein they are also able to manage the compliance and regulatory issues. At Northern Arc, we've been doing this business for the last 8 years now. We've built a scalable portfolio. And as a result of that, we've also built a platform which is today available to banks. So our platform NPOS is available to banks to take care of their needs of both co-lending, CLM1, CLM2 and DA transactions. Maybe I'll talk through it more, but I guess banks, there are challenges, but the opportunity is large. And I think if you mitigate those challenges through, the way the program is designed and the way we build the technology around it, I think this is something which is definitely scalable.
Thank you, Amit. This is good take. So, Ramas, coming back, so co-lending, you already spoken about becoming one of the critical business decisions to scale your lending business, right? So, what are the critical considerations that, as a bank, that you look at it to build a partnership? Because primarily you will be the lender in the partnership, right? So, what kind of the factors that you consider, and what are the things that you expect from your partners?
Yeah, I think there are several things that we need to keep in mind here, and I'll try and focus on the bank's perspective here. While obviously there are considerations at both ends, right? But I'll just speak about the bank's perspective. I think the first and foremost and most important thing, Shashank, is the partner selection, right? I think if you don't get the right partner, and when I say partner selection, it is not just about who's the player and what are they doing. I think it goes much deeper into that, right? So obviously you will look at management, you look at vintage, you look at experience in the business, you will look at financial results. All of those things are given, the rating, right? But beyond that, I think you need to go deep dive into specifics on the portfolio. And when I say portfolio, I don't mean necessarily only the segment that you want to get into partnership with on the NBFC side. But deep dive into the portfolio in terms of how has their track record been in terms of their delinquencies, stress levels, collection efficiencies, how was their sectoral performance, whether it is cut by bureau, whether cut by geography, cut by sector, cut by occupation, all of those things. You need to get into real details to be able to understand how the NBFC has been doing before you decide to partner with them, because the co-lending partnership, and we spoke about technology challenges and all that, right? It takes a lot out of, from an effort perspective, while there are platforms. And of course, Amit represents one too, apart from his other hat as an NBFC. There is a lot of effort which goes in. So you need to get it right, because if you don't get it right, it's all investment of energy, time, money spent for not much, right? Because you can't then scale the business really. So, and Karnataka Bank, without getting into names, we have also had some of our initial experiences were not so great. And it was a lesson well learned also that yes, we need to invest a lot of energy and time into getting into understanding the partner a lot more. So that's number one. Number two is the entire challenge of aligning risk appetites between the NBFC and the bank, right? And this is a huge thing again, and this is also one of the big challenges which we continue to face, right? Banks have their own, strict, banks obviously are much more stricter in terms of customer selection, in terms of bureau cutoffs, in terms of bureau behavior, in terms of whether write-offs are there or there is any settlement, all of those things, banks have kind of much tighter in terms of their norms. Look at secured lending again, right? From a collateral perspective, banks will be more comfortable with more perfect collateral, as you say. Whereas NBFCs, that may not be the case, right? They are more nimble, they are more, their appetite for taking risk, the cost structures permit them to do that maybe, and all of those things are there. But yes, so the risk alignment is very critical. Otherwise, you will never be able to kind of scale this business. And that's again, something that you need to really take care of. And connected to risk is the pricing, right? So how are you going to price this relationship? NBFC is lending to the customer at 19-20%. You are going to lend to, bring this to the arrangement at maybe 10%, 9%, whatever. How are the dynamics going to work out, right? It's got to be a win-win for both, isn't it? I mean, if you, and this is where your loss estimation and other things come in. And you'll also do a lot of understanding on the credit assessment methodologies that the NBFC follows, which again will be very, very different from what you would do as a bank. So all of these things need to be taken into account. You need to have pricing metrics, which kind of is a win-win for both. Because on the one side, if you price it too high, then obviously the NBFC with its high cost structure will not be able to make money. On the other hand, if you're pricing it too low for the bank, and if the losses go beyond your estimates, then suddenly you're sitting with a loss. So you need to take the pricing into account. Third aspect, of course, is technology, and we've already spoken about that. I think technology is critical if you're not having the integrations in place. And there are some great platforms now already available where they play a great role in terms of being able to bring this integration into play. We work with two of them, UB and of course with NPOS, which Amit represents here. And that has made life a lot easier, definitely. Still a long way to go, because we still find that despite having these platforms, each one of our partner integrations are still bespoke, right? It is not as if you can just plug in and start. It doesn't work like that. So that is another challenge that we need to overcome. Apart from that, there are other issues, right? Internal management of teams, right? So there is the compliance, there is risk, who are all stakeholders to this, right? And if you don't align your stakeholders internally within the bank to this arrangement, then boss, it's not going to happen. So do that early enough as part of the arrangement so that you can ensure that it is smooth riding after that. The last two things I would say is, yes, one is of course, in terms of the approach to co-lending, I would believe that you should start small because as I said, it is it is something that you need to test out, see how it works for both partners and then scale it from there. And that's the approach we have taken to co-lending. That's how we've started building our book over the last 1 year now. And the last one is continuous reviews, right? And a lot of communication between the two partners, because if you don't review this portfolio jointly on a monthly basis, then again you will be in for surprises suddenly, and then you find that you're not going in the direction that you wanted to. So I think a lot of these things need to be taken into consideration before you arrive at a partnership, and then through the partnership, how you kind of build this business out.
Thanks, Ramas. I think it was good multi-dimensional coverage. Maybe Amit, you may like to add from NBFC perspective, and also I would like you to touch upon some of this other critical element of the co-lending, like underwriting consistency or say operational challenges for the customer support and all these things.
So I think if I talk about Northern Arc, I think what we've ensured is we have standard protocols of how we want to operate this. Thanks to the kind of technology we've built, we are able to have standard protocols across the segments and the sectors that we operate in. So our platform today allows you to build this business across the segments, be it secured lending or LAP, then unsecured businesses, both business loans, personal loans, two-wheelers, commercial vehicle and all that, right? So each of these segments have their nuances, and as Ramas was saying, while each of the partnerships will be bespoke, 70 to 80% of those integrations and those interactions are similar, which is the balance 30% is which is where the key is, right? Which you have to get it right, and you have to get it right in the first go. So we ensure that the partners that we work with, both banks and NBFCs, get digital data so that they can have access to data on tap real time and are able to underwrite and utilize that data for decision making. That's one critical thing, so that you're able to offer the seamless experience which the fintech and the NBFCs expecting. Second key thing is that as you sort of scale this portfolio and build this business, building early warning signals which are backed by data is very critical, which is again where you need to invest in platforms and technologies where you can get access to data from your partner on tap at a very high frequency and build early warning signals around that. I think with the kind of innovation which has been around, we've seen models working out, and then regulatory challenges or regulations coming in place. So one has to be very agile to be able to make those changes swiftly. And if not invested early, if the bank has not invested early in a platform or in a system which allows them to do that, I think it becomes very difficult to manage this at scale. From our own experience, we have a fairly large portfolio at Northern Arc through this partnership model, where we work with NBFCs, we work with fintech partners across the segments. So beyond lending, it's or disbursements is also about managing the life cycle, where reconciliation at scale is a very big item, where we have seen a lot of systems not being able to perfectly do that. But with a lot of experience that we have been able to sort of bring into doing this is something that we are able to solve for, which remains a challenge for a lot of NBFCs and banks in this segment. Then, as you go to CLM1, there are items around CRM, there are items around, collections, etc., where the expectation that the regulator has are very, very different. Today, the regulator expects us to report NPAs on a daily basis. So that access is something which can happen, can be made available only if you have that deep interaction and integration with the partner at multiple levels, not related to only business. So that is where something, the success and the scalability will come from.
Thank you, Amit. Thank you. So, Pulak, now coming to you. You are a technical developer where that both the originator and lenders are sitting on both the side of the technology, right? So, when you are interacting with both the parties and technology is now given that plays a critical role into the co-lending. So, what are the things that typically you understand that need to be solved from the technology perspective so that the entire co-lending can collaborate and grow bigger?
Wonderful question. And just on the lighter note, I don't know, was it arranged or a fintech is sitting between an NBFC and bank? So look at from the macro perspective. I see three problem statements. Probably not highlighted so far right now because Northern Arc has been able to do a tech platform for themselves to scale it up, right? But at a macro level, are we having such NBFCs who can do it for themselves? I say 80% will not be able to do it. So problem at macro level is the tech is not there. Now looking from the NBFC perspective, there are two problem statements and one joint problem statement for all the players. So two is one, obviously shortlisting and having a partner for co-lending. As Ramas suggested, it is a time-taking, working hard kind of a setup which gets in, when we go live. So again, I would put it this way. One, obviously the manual effort which is there, but a technical integration and other aspects also come into the play, which is, and again, a problem at a bank level. So when I say tech, so tech is a problem at NBFC as well as the bank. Major problem. Second, operational efficiency. Again, because it's a multi-entity setup, it is not a straightforward one entity giving money and one collecting, or they are collecting it. Now the problem statement with having multi-entity is the joint responsibility comes on everything, right? And the compliance, does not allow everywhere that two parties take care of this aspect, especially RBI being very strict on it. We need to shore off that compliance is made. And personally, if you ask me, that can be done through tech right now. Not taking away anything from Northern or any player who has done it. We need somebody who can actually take this, or couple of players who can take the co-lending as a space itself way forward in a manner that it can be adopted by all NBFCs and higher number of banks and quickly can be implemented. So my view again from a macro level, I think that's the reason I have been saying it is right now we are at a very early stage. We can go bounds and leaps on this, and frankly happy to join hands and everywhere, and it is just a matter of time that people will jumping onto it. It is just about that time.
Thanks, Pulak. So, Rama, I'll come to you. Pulak has already touched upon some of the compliance aspects, and you also touch upon. But what are the critical regulatory considerations that need to be addressed, and how do you address those things, be it from the NPA management to customer service across all the things? What are the critical things? And that's very important to scale the co-lending business.
Absolutely. So we all live and die by the regulator, right? So compliance is critical, super critical. And so from a co-lending perspective, of course, we need to look at several things. One, of course, as I said, the guidelines are there, available in black and white. The 220 regulations which came out, which talk about what co-lending is all about and what are the rules and responsibilities of each of the players in the co-lending space. Apart from the co-lending regulations, the banks, we also have to look at outsourcing guidelines, because you can't outsource underwriting. Being a core function of the bank, while the NBFC would of course originate and underwrite, you will need to underwrite it again. So there is a process which needs to kind of, we need to go through there. So I need to therefore look at the outsourcing guidelines. The third and critical aspect is of course the KYC guidelines again. So again, the comfort here is because it's a RE to RE kind of a setup, and there are guidelines which allow you to rely on the KYC done by the NBFC, but that doesn't mean that you don't satisfy yourself as a bank, because you will still get questioned by the regulator and you need to be having the answers. You can't say that I have no idea. So you need to take all of those things into consideration from a compliance perspective. Apart from that, of course, there are many other things that the regulation says, right? The bank needs to have a well-defined policy on co-lending, clearly defining the contours of the arrangement, what kind of partners you will choose, how it will work. All of those things will be there. Then there needs to be a firm agreement between the co-lenders, between the two partners, which again lays out the terms and conditions, the SLAs. All of those things need to be there. From a funds perspective, we need to ensure that there is no commingling of funds. So you need to ensure that this is escrowed, the collections are escrowed, so that you can clearly demarcate and identify these funds. So a lot of these things are there from a compliance perspective that you need to kind of take care of. And then of course, if you're going for the CLM2 model, then that is very much akin to a DA, right? Because CLM2 has pretty much eaten into the DA, direct assignment kind of business, right? So you need to also look at those guidelines from a DA perspective. A lot of those guidelines, of course, the MHP, the minimum holding period and those kind of things are exempt here, but you will still need to look at those guidelines to ensure that you are complying with them. So a whole lot of regulatory guidelines and considerations come into play, like for any other business that a bank or a NBFC would do, which apply here also, but you need to be kind of on top of all of that. Apart from that, from a risk perspective, and I've already spoken about this, but just to kind of reiterate, right, risk again becomes very critical. And that's where the entire pricing thing, metrics comes into play, right? And because if you don't price for the risk that you are perceivingly getting into, then you're going to not make money in this business. So I think, that's what I would say, Shashank.
No, thanks, Ramat. So Pulak, again, coming back to you, Ramas spoke about lots of the compliance requirement from that, and you spoke about that technology can play a bigger role into addressing those other compliance. So maybe you can just throw a little more deeper that how you see the technology playing a role into addressing lots of the compliance. May not be everything, right? It's not easy.
Correct. So again, the problem statement is scale. I come to that. Why scale? For a bank, having 1, 2, 3 partners still manageable operationally as well as maybe onboarding. But when we want to go scale, maybe 10 times from here, then practically it is not possible manually, right? So the systems, eventually every other BFSI player other than NBFC and banks had certain compliances which they were able to solve so far, right? I think the point was again how much we want to scale it, and once we figure it out, we can move further more on compliance side. I'm sure every bank is following it, every NBFC is following it, but the problem statement right now is to manage it efficiently for higher number of transactions, higher number of clients. That is the problem statement. Right now, I don't think banks or NBFCs are not able to follow the compliance. They are able to do it. The problem is with a lot of manpower, lot of efforts, that needs to be taken care of, which can be and being done by technology today as well. I'm sure Northern Arc is able to do so. So looking at a scale, if technology can do it for one, it can be do the same for 10 furthermore.
Thanks. So Amit, coming to you, so you already established technology has been a core to your co-lending business. But how do you see the role of the AI and the data analytics into the overall technology landscapes to play a bigger role into the co-lending business to scale?
So see, as sort of we strike these partnerships, right? And at Northern Arc, we not only work with NBFCs, we work with a lot of fintech partners, and we get access to a lot of data. We ensure that this data comes to us in a digital format. And then through our analytics desk, we are able to build analytical models. Specifically, NewScore, which is one of our analytical models, is available to banks, wherein we can support the banks in underwriting a variety of loans. These are customizable models built for banks specifically, looking at their sort of segments, etc. So what we are doing at Northern Arc is building this NewScore for each of the segments that we operate in and offering it to banks today. Our early warnings, collection, systems also are built based on the data that sort of we get. A lot of focus at Northern Arc for us has been to collect the data digitally, to be able to process it properly, and then of course apply science to sort of get decision making out of it. We are able to support. We are supporting a few NBFCs today with the NewScore that we are offering, specifically for the segments where this was not available. So barring personal loans, scorings, algorithm-based models are not really available for other sectors. So our focus has been to offer for those segments, where we've seen some initial very good pickup, and that today is a commercial offering that we are sort of offering to a lot of these banks today. This scoring, is today available for underwriting, and we are expanding the base to also cover a lot of aspects of risk management, including early warning, collections, etc. So a lot of focus is there, and I think we will see that pick up as we speak.
Thank you, Amit. So before I go into my last set of questions, maybe I'll just open the floor because I can see people may be asking questions. So can we have some mic, please? And I'm just requesting just to be crisp in the questions so that at least we can have more questions. Yeah.
Thanks for very insightful session. My question is, I've one of the top 3 credit rating agency for the NBFC which are doing co-lending. It is still not treating it as an off-balance sheet, but on-balance sheet for the purpose of calculating lending. And when I spoke to them, they say they have seen a lot of cases where banks arm twist the NBFCs to replace the bad loans with the good assets. So that's why we are still not comfortable how it will play out. So any comments on this? How prevalent this practice is? Is it one-off, and why credit agencies is still not comfortable treating it as an off-balance sheet? And
I can start by telling you we don't do it, if that is of any comfort. No, but see, as we spoke about the importance of compliance, right? I mean, I don't think there is any such thing which can happen. If it is happening, it is short term and it won't last long, right? The only problem in co-lending as compared to a BC or a LSP model is that, of course, there is no FLDG. As you know, the regulations don't permit that. And if that had been there, I think probably, and you can argue for and against it, and I'm sure the business would have, and banks would have been much more forthcoming in participating in co-lending, I'm sure. But having said that, I'm saying if there is any such practice, then it's very short term, it will not happen. The fact is that the key lies in ensuring that you do your homework, as I said, in terms of the partner due diligence, and if you have a clear understanding of their credit behavior, then you can assess when you work out your P&L, you know where you're going to end up with broadly, right? Unless there is some kind of a event which is beyond your control, but broadly because you've done your homework well, where the credit cost is going to be, and accordingly what kind of ROA you're likely to end up with, right? So yeah, that's what my view is.
Thanks.
If you want to add something from the...
No, so I think I completely agree with Ramas. Whatever is happening maybe is with some informal arrangements that is there. But from a regulatory perspective, nothing of this sort is possible. I think rating agency should, at Northern Arc, we take a clear view that if there is an arrangement where there is a clear participation in terms of risk available, then it has to be accounted for in the financials. Beyond that, I think it may be futuristic arrangements which can fall in place. So that's what we have seen, and obviously this is not going to stay as we see the regulation evolving. With this clear definition of how much FLG is possible, who can provide FLG and all that. So that's where I think it has evolved over the last 2 years, and more clarity has come in now. We should expect to see this being implemented in letter and spirit as we go.
Thanks, Amit. Maybe in other questions, please.
Hey guys, I think this has been a very insightful thing. One of the better co-lending discussions I have been a part of. One thing which is there, as Ramas said, that while technology is there, there has been only one-to-one interaction because there is a lot of operational work. One of the operational work is accounting. Okay, and this is something which is very interesting because banks have a very set accounting standards and NBFCs have a very different accounting standards. And this doesn't match. 99.9% time, as the gentleman said, the bank has to force their accounting system on the partnership, which makes the NBFC go through a nightmare. And you know, this I've seen can be a reason for a very large scale blowout which is impending from last 4 or 5 years in the co-lending. How do you guys think this can be addressed?
Maybe I can take that. See, clearly there are banks who have straight-jacketed systems and processes which will not change. They have systems which are designed to sort of on a particular logic, right? That will not change. We also have larger NBFCs who will not be able to change it for every bank today, right? So what we've seen happening is it can always be, so we will not ask the bank to change its systems, and neither will the NBFC change it. It will always be managed through a commercial arrangement which can then be managed by a middleware, which is what we are offering, where it starts from as you draw up the repayment schedule, right? Some banks have a different logic, NBFCs have a different logic. We won't change the two, but the risk participation and the arrangement that we have can take care of that, which is what the system that we are offering NPOS is able to sort of cater to. So, yeah.
Thanks. Maybe Pulak, you want to add for technology perspective?
So probably I'll put it, it is more of fintech thing coming into the play rather than the NBFC play. So yeah, the tech is required again to manage in between. Answer to your query is that. So either through, NBFC able to build it, or any third party platform or a tech player who can solve this or who has solved it can actually use this for the co-lending model. Can be used by.
Thanks.
Can I just add? Yeah, so I would like to add here. So I think I echo what they're saying. The platform has helped, right? It has helped us to ensure that we are able to manage this accounting, the 80/20, the repayment schedules, all of those things we have been able to manage that well because of the platform presence. But having said that, what we have also done, because the regulation again stipulates that all your, the loan accounts need to flow into the bank's core system also, right? That's the way the regulation is. So the loan accounts have to be maintained at both ends. So even when I open my loan account in my core system, at least I know that because my processes are already set, right, I'm able to follow, suit accordingly. We have done both ends. There are models, especially in the DA side, where banks don't bring it into their core, and they hold it onto the intermediary platform, and they only pass GL entries into their core system and all that. So we have followed both models, and there are pros and cons of both. I think it's ultimately a matter of what is comfortable for you and how it can work out well in terms of ensuring that whatever standards you need to meet, whatever reporting needs to happen, whether it's to the regulator or whoever, is happening as per the norm.
No, thanks, Ramas. And I think there's so much to deep dive into the co-lending, especially with the panelists here. But we have to come to an end to the session. But thank you all the panelists, Ramas, Pulak, and Amit, for wonderful interactions. Thank you very much.
Thank you. Thank you so very much, Mr. Shashank. Can we have a louder round of applause for all our speakers? Thank you, Mr. Shashank, for driving that conversation, and of course to all our speakers for giving us so much food for thought. May I now request a moderator to felicitate all our speakers with a token of appreciation. Well, that was some crucial insights and key nuggets on how really financial institutions can scale the co-lending models while also ensuring a regulatory adherence. Well, let's keep those applauses going. I believe we had some good lunch outside, so let's gallop that energy inside the room. And a round of applause for all our speakers right there. Thank you for sharing such key insights and key data points with us. And I would urge you all to please come together for a group picture. It's time we get you all clicked in the same frame.